Here's a question most people never ask themselves. Why do some people quietly build wealth while working the exact same jobs, earning the exact same salaries as everyone else around them? It's not luck, it's not intelligence, and it's almost certainly not income. Almost every time, it comes down to one thing: knowing how money actually works. And today, I'm going to show you exactly that. Index funds, mutual funds, hedge funds, ETFs. You've probably heard these words thrown around by finance influencers, by that one friend who acts like he's Warren Buffett, maybe even in the news. But here's what nobody tells you. Most people who throw these terms around don't actually understand them. They're repeating words they heard someone else say. In the next 17 minutes or so, I'm going to break all of this down in a way that's so clear, so simple, that by the end of this video, you'll understand these instruments better than 90% of adults who've been in the workforce for decades. No jargon, no fluff, no condescension. We'll cover what a fund actually is, the different types, how they're managed, the real risks, the hidden fees, and most importantly, which one is actually right for you. And stick with me until the very end, because the last section is where I'm going to show you the single most expensive mistake people make with their money, and it's one almost nobody talks about. Before we dive in, this is not financial advice. Everything here is for educational purposes. Always do your own research before making any investment decisions. All right, let's go.
Before we get into the different types, you need to understand what a fund actually is, because once you get this, everything else clicks instantly. Imagine you and your friends want to throw a birthday party. No one person has enough money to do it alone, so everyone chips in. With that pooled money, you can get food, drinks, decorations, a cake, maybe even a DJ. No one is overwhelmed, and everyone gets to enjoy the full experience. That is exactly what a fund is. A group of people, sometimes thousands of people, pool their money together. That money is then managed and invested across a variety of assets: stocks, bonds, real estate, and more. Instead of you needing to research, pick, and track every single investment yourself, the fund does that heavy lifting. You simply share in the results, the gains, and sometimes the losses. Simple, elegant, powerful. Now here's where most people check out, and that's exactly where they get left behind financially. Because not all funds are the same, not even close. The differences between them in how they're managed, how they're priced, and how much they charge you could either quietly make you wealthy over the next 20 years or silently drain tens of thousands of dollars from your portfolio in fees you didn't even know you were paying. Let me start with the one you've probably heard the most about. You've seen it on social media. Some finance creator says, just throw your money into an index fund and forget about it. But what does that actually mean? An index fund is a fund that doesn't try to pick winning stocks. Instead, it copies a list called an index of companies. Think of an index like a scoreboard. It's a pre-selected list designed to track a certain slice of the market. The most famous one, the S&P 500. Now here's something most people don't know about the S&P 500. It's not simply the 500 biggest U.S. companies. There are actual eligibility criteria. A company must be publicly listed, based in the U.S., have a market cap above $18 billion, be profitable for the most recent quarter and cumulatively over the past year, and meet certain trading volume requirements. This is why some massive private companies aren't on it. When the S&P 500 goes up, it generally means the large-cap U.S. market is performing well. Then there's the NASDAQ, heavily tech-focused, home to Apple, Microsoft, Meta, and Amazon. It's delivered some of the strongest growth over the past decade. And the Dow Jones, just 30 large, iconic American companies across different industries. Think Coca-Cola, Boeing, Goldman Sachs. There are also indexes for small-cap companies, international markets, emerging economies, bonds, and specific sectors like energy or healthcare. Here's the key insight. Index funds are passively managed. Nobody is sitting there making daily picks. They simply mirror the index, and that keeps fees incredibly low, typically just 0.03% to 0.20% per year. On a $10,000 investment, you might pay as little as $3 to $20 annually. Vanguard, BlackRock's iShares, and Fidelity are among the biggest names offering these funds. But here's something that catches a lot of new investors completely off guard, and it has to do with when and how you can actually buy or sell an index fund. I'll explain that in a second.
Here's something that surprises a lot of new investors, and I want to make sure it doesn't surprise you. Unlike stocks, you cannot buy or sell a traditional index fund at any moment during the trading day and lock in that exact price. Instead, index funds are priced just once per day, after the market closes at 4 p.m. Eastern Time. That price is called the net asset value, or NAV. Here's how the NAV is calculated. Take the total value of everything the fund holds, subtract the fund's expenses, then divide by the total number of outstanding shares. Whatever that number is at market close, that's the price you get, regardless of when during the day you submitted your order. So if you put in a buy order at 11 a.m. on a Tuesday, your trade won't actually execute until after the market closes that afternoon. Place your order before the daily cutoff time and it goes through that day. After the cutoff, it rolls to the next trading day. For most long-term investors, this honestly doesn't matter much. If you're holding for 10 or 20 years, buying at slightly different intraday prices is noise, not signal. But if you're someone who likes real-time control over your entry and exit prices, this is critically important to understand before you're caught off guard by a delayed trade, especially during a volatile market. The takeaway: index funds are designed for patience, and patience, statistically, is one of the most underrated investment strategies in the world. Now, what if you want someone to actively manage your money instead of just tracking an index? That brings us to mutual funds. At first glance, mutual funds look a lot like index funds. They both pool money from multiple investors and spread it across a range of assets. But here's the critical difference, and it affects your real returns more than almost anything else. Mutual funds are actively managed. That means there's a real human, a professional fund manager, sometimes an entire team with MBAs and decades of experience, making daily decisions about what to buy and what to sell. Their goal? Beat the market. Outperform a benchmark like the S&P 500 by consistently making smarter picks. Sounds great, right? Here's the catch. Active management costs money. Mutual fund expense ratios typically run from 0.5% to well over 2.0% per year for actively managed equity funds. That might not sound like much, but let me give you a number that will change how you see this forever. On a $50,000 investment growing at 7% annually, the difference between paying 0.1% in fees versus 1.5% in fees over 30 years is over $180,000. Not in returns, in fees alone. And here's the brutal truth the fund industry doesn't advertise. According to the SPIVA report, one of the most respected long-term studies on fund performance, over a 15-year period, approximately 88% of actively managed U.S. equity funds underperformed their benchmark index. That means the expensive manager, on average, did worse than just buying the index and doing nothing. Still, mutual funds aren't completely useless. Some investors prefer them for targeted exposure to strategies, sectors, or international markets that aren't easily accessible through standard index funds. And some managers genuinely do outperform, at least for stretches of time. Big providers like Vanguard, Fidelity, American Funds, and J.P. Morgan offer wide ranges of both actively and passively managed mutual funds. Always check the expense ratio and the fund type before you put a single dollar in. One more thing, just like index funds, mutual funds also trade at end-of-day NAV prices. Same cutoff time rules apply. Also worth knowing, many mutual funds have minimum investment requirements, often $1,000 to $3,000 to get started. That's a real barrier for newer investors, and it's one reason ETFs have exploded in popularity. We'll get there.
Okay, pause for a second. I want to ask you something directly. Right now, in this moment, based on what you've just learned about index funds and mutual funds, which one sounds more like you? Are you the patient, low-cost buy and hold type? Or do you like the idea of an expert making active calls on your behalf? Drop your answer in the comments. I genuinely read them, and it'll help you stay accountable to understanding your own investing style. Because here's the truth. The biggest returns aren't always about picking the right fund. They're about picking the right fund for your personality and actually sticking with it. All right, now we're going into the deep end, and I mean that literally. Because what comes next is the world of hedge funds, where the rules are completely different, the strategies are wild, and the stakes are almost incomprehensibly high.
Hedge funds. Even the name sounds exclusive, and that's completely intentional. These are not for the average investor, and by the end of this section, you'll understand exactly why. And why, that's actually fine. The word hedge originally referred to reducing risk, but modern hedge funds are really more about chasing aggressive, outsized returns, often through strategies that would make most people deeply uncomfortable. So, what is a hedge fund exactly? It's a private investment fund that pools money from ultra-high net worth individuals and large institutions, pension funds, university endowments, sovereign wealth funds. Unlike mutual funds or index funds, hedge funds can deploy strategies that sound like science fiction to everyday investors. Short selling, betting that a stock's price will fall by borrowing shares and selling them before buying them back cheaper. Leverage, borrowing capital to invest far more than the fund actually holds. Derivatives, complex financial contracts that derive their value from other assets. Some hedge funds trade currencies, commodities, real estate, private equity, distressed debt, and more, all within the same portfolio. Fund managers in this space often have enormous, almost unchecked freedom to take concentrated positions. That freedom can produce extraordinary profits. It can also produce catastrophic losses. In 1998, long-term capital management, run by two Nobel Prize-winning economists, nearly collapsed the global financial system. That's not an exaggeration. That's what hedge fund risk looks like at its extreme. That's exactly why hedge funds are restricted to accredited investors, people who meet strict income or net worth thresholds set by regulators. In the United States, that means either an annual income exceeding $200,000 for 2 consecutive years or a net worth exceeding $1 million, excluding your primary home. The logic is that if you're that wealthy, you can absorb the risk. And then there's the fee structure. Hedge funds are famous for the 2 and 20 model, a 2% annual management fee plus 20% of any profits, though in recent years this has softened significantly. Many funds now charge closer to 1.5% and 15% or less, as institutional investors have pushed back on the historic fee structure. Sometimes these funds deliver, sometimes they spectacularly don't. ETFs, exchange-traded funds, are arguably the most elegant financial invention of the last 30 years, and I want to show you exactly why that's not an exaggeration. Think of an ETF as a hybrid. It combines the diversification of an index fund with the real-time flexibility of a stock. And for most everyday investors, that combination is genuinely hard to beat. Here's what makes ETFs fundamentally different from traditional index funds. They trade throughout the day on a stock exchange, just like individual company shares. That means you see the live price in real time, and you can buy or sell exactly when you choose. No waiting until 4 p.m., no uncertainty about what price you'll get. They also carry extremely low fees. Most ETF expense ratios range from 0.03% to 0.75%, and many index tracking ETFs are even lower. Because the vast majority of ETFs passively track an index, there's no expensive team of analysts driving up costs. Now here's something that surprises almost everyone. If you want to invest in the S&P 500, you can do it through a traditional index fund or through an ETF. Both track the same underlying index. The main differences are how and when they trade, and something very few finance videos ever mention: tax efficiency. When mutual fund investors redeem shares, the fund may need to sell underlying holdings to raise cash, which can trigger capital gains taxes that hit all remaining shareholders. ETFs use a different mechanism called in-kind creation and redemption, where large institutional investors exchange baskets of securities directly for ETF shares. This process shields regular investors from most of those tax events. For long-term investors in taxable accounts, this can be a meaningful advantage. ETFs also have very low minimums. Most brokerages let you buy a single share, and many now offer fractional shares, meaning you can invest with as little as $1. In terms of pure practicality, ETFs offer diversification, low cost, real-time flexibility, and tax efficiency all in one simple instrument. That's a hard combination to argue with. Before I give you the final verdict on which fund is right for you, I need to take 60 seconds to show you something that almost no one fully grasps until it's too late: compound interest. Albert Einstein may or may not have actually called it the eighth wonder of the world. The quote is likely apocryphal, but the math behind it, that part is completely real. Here's a simple example. If you invest $10,000 today in a low-cost S&P 500 index fund and leave it completely untouched, assuming the historical average return of roughly 10% per year, in 10 years, you'd have approximately $25,937. In 20 years, approximately $67,275. In 30 years, approximately $174,494. You did nothing. You didn't make a single trade. You didn't watch a single earnings call. You just left money in a boring fund for 30 years, and it grew by 17 times. Now, what if you waited 10 years to start? Same fund, same returns, but you start at year 10 instead of year 0. After 30 years of total time, you'd have roughly $67,275 instead of $174,494. That 10-year delay cost you over $107,000, not because the market performed differently, just because of when you started. This is why the finance world has a saying: the best time to invest was yesterday, the second best time is today. Okay. Final section, and this is the one I told you at the beginning you absolutely cannot miss. All right, let's bring it all together, because this is where most people either make a brilliant decision or a very expensive mistake. Earlier, I told you I'd reveal the most expensive mistake people make with their money. Here it is: waiting to understand it before starting. The cost of waiting, as I just showed you, is enormous, and complexity has kept more people on the sidelines than almost anything else. So let me make this as simple as possible. If you're an everyday investor building long-term wealth, index funds and ETFs are almost always your best starting point. They're low cost, easy to understand, broadly diversified, and the long-term data, not opinion, actual data, shows they consistently outperform the majority of actively managed funds over 10 to 15-year periods. Even Warren Buffett, widely considered the greatest stock picker in human history, has made his position clear. In his 2013 letter to Berkshire Hathaway shareholders, and later reinforced by a real 10-year bet against a hedge fund manager, he stated that most people are better off putting their money in a simple, low-cost S&P 500 index fund and leaving it alone. That's not a throwaway quote. That's a conclusion backed by data, experience, and billions of dollars. Mutual funds can make sense if you have a specific conviction in a manager's strategy, or if you need targeted exposure to a niche market that isn't accessible through index ETFs. Just go in with eyes fully open, check the expense ratio, check the 10-year performance versus the benchmark, and be realistic about what you're paying for. Hedge funds? Unless you're already a qualified, accredited investor with significant risk tolerance and capital to spare, they're simply not designed for you. And that's not a criticism, that's clarity. Here's the truth nobody in the finance industry wants to say out loud, because it would put a lot of expensive advisors out of business. You don't need complexity to build real wealth. You need consistency, patience, a low-cost strategy, and the discipline to leave it alone. You're not a gambler, you're a builder, and builders work with the best tools, not the most expensive ones. That's it. That's the whole game. Now, before you go, tell me in the comments which fund type are you planning to start with or are already investing in. I read every single comment, and I'll reply to as many as I can. If this video helped you see this more clearly, hit like and subscribe.